You walk into a market. On one side, you see a ready-made fruit basket with a little bit of everything. Apples, bananas, oranges. On the other side, you see a single perfect expensive mango. Which one do you buy? Well, choosing between an ETF and a stock is exactly the same choice. One gives you a bit of everything instantly. The other is a bet on one single thing. Let's break down which shopping strategy is better for your financial diet. Welcome to the Investment Nerds, your personal guide to investing in the African stock market. What are they? Let's define our terms clearly. A stock is like that single mango. When you buy a stock, you are buying one piece of a single company, like MTN or Amazon. If that company does well, you win big. If it goes bad, your mango rots. An ETF, exchange-traded fund, is like that fruit basket. It's one single product you can buy, but inside it holds little pieces of many different companies. Maybe some MTN, some Nestle, some banks. You get instant variety. The key differences: risk, diversification, and cost. Now, why does this matter? Because of three big things. 1. Diversification, the don't put all eggs in one basket rule. ETFs, you are automatically diversified. If one company in the basket has a bad year, the others can balance it out. It's much safer. Stocks, you are putting all your faith and money into one company. High risk, high reward. 2. Risk and reward. Stocks can skyrocket or collapse. You could double your money or lose half of it quickly. ETFs smooth out the ride. They blend winners and losers, so the value is more stable. You probably won't get ultra-rich overnight, but you also probably won't go broke overnight. 3. Cost and effort. ETFs usually have low fees and require less work. You buy the basket and you're done. Perfect for beginners. Stocks require more time and research. You need to study each company you buy, which can be a lot of work. Which one is for you? So which one should you choose? Ask yourself, you might be an ETF person if you're a beginner. You don't have time to research companies every day. You prefer a steadier, less stressful approach to growing your wealth. You might be a stock person if you enjoy researching companies and understanding their business. You can handle the risk of one investment performing very poorly. You're looking for a chance to hit a home run with a specific company you deeply believe in. One important warning from the infographic: not all ETFs are safe. Most are, but watch out for complex types with names like leveraged or inverse ETFs. These are like a fruit basket that uses borrowed money to buy more fruit. It can amplify your gains, but it can also amplify your losses massively. As a beginner, stick to simple broad market ETFs. So, to recap it, ETF equals a diversified basket of stocks. Lower risk, less effort. Stock equals a single company. Higher risk, higher potential reward, more effort. This is not a recommendation to buy or sell any specific ETF or stock. All investing involves risk, including the possible loss of principal. Conduct your own research and consider your personal risk tolerance. Based on your personality, does the fruit basket ETF approach or the single mango stock approach appeal to you more right now? And why? Comment ETF of stock in the comment section below. Want to learn more? Hit that subscribe and follow button for tips.